Central bank interest rate decisions are among the key factors that influence global financial markets. Understanding how to anticipate these decisions can make all the difference in your trading strategies. Hello and welcome to my channel. I'm David, a financial analyst with over 29 years of experience in currencies and commodities. Today, I will be guiding you through how to predict central bank interest rate decisions. Interest rates play a critical role in trading, and not just in the currency markets. Take the United States as an example. There are times when a Federal Reserve decision is anticipated well in advance of the FOMC meeting, but at other times, uncertainty lingers. When that happens, what should you do? If you have been trading for a long time, there have likely been moments when you wondered what the Federal Reserve's next interest rate decision would be. One of the key elements in anticipating these decisions is the federal funds rate, which is among the most impactful interest rates in the U.S., set by the Federal Open Market Committee, FOMC. This rate represents the interest that banks charge each other for short-term lending, typically overnight. Traders often look at 30-day Fed funds futures, ticker ZQ, to hedge or express their views on potential shifts in the short-term rate. These contracts, priced at 100 minus the anticipated Fed funds rate, capture the market's collective view on the Federal Reserve's monetary policy trajectory. To assist in interpreting these market expectations, the CME Group created the FedWatch Tool, which calculates the probability of rate changes based on the 30-day Fed funds futures. This tool becomes particularly useful during periods of uncertainty, when predicting the outcome of FOMC meetings is more difficult. It essentially serves as a barometer for possible Federal Reserve moves. Let's take a closer look at how to use this tool effectively to predict interest rate movements and anticipate shifts in the market. Now, let's examine the data from the FedWatch tool as of the close of Friday, 4 October 2024. It is quite simple to understand. In the top left corner, you can find the dates of the upcoming FOMC meetings and select the one you are interested in. I will choose the upcoming 7 November 2024 meeting. At present, the FOMC's current target rate stands at 475 to 500 basis points. The chart displays two distinct bars. The bar on the left shows the probability of a 25 basis point rate cut, reducing the range to 450–475 basis points, while the bar on the right shows the likelihood that rates will stay unchanged. There is a 97.6% probability of a 25 basis point rate cut at the 7 November FOMC meeting. This indicates a strong market expectation for a rate reduction by 25 basis points. Below the chart, you can compare these expectations with those from 1 day, 1 week, and 1 month ago, which helps you track how market sentiment has shifted. As shown here, a week ago, the forecast for a 50 basis point rate cut was 53.3%, but now it has dropped to 0%. In the left-hand menu, you will find several key entries worth exploring for a more complete picture. One particularly useful entry is the dot plot under the chart section. 4 times a year, the FOMC releases a dot plot, which displays each committee member's expectations for future monetary policy. Each dot represents an individual member's forecast for the midpoint of the federal funds rate target. This gives you a detailed snapshot of their outlook for future rate changes. The CME FedWatch tool lets you directly compare the FOMC's projections with market expectations reflected in Fed funds futures. The blue dots on the chart show the median FOMC forecast, while the red dots reflect the market's anticipated effective rate by year's end. This allows traders to see whether the market's outlook aligns with or diverges from the FOMC's. It is not just with tools like the FedWatch tool, but it is also possible to easily predict interest rates for other central banks. I will present a couple of practical examples of interest rate forecasting for the last months of 2024, using futures contracts with a focus on the Eurozone and Australia. The calculation method is the same as I outlined for the United States. Interest rate equals 100 minus futures contract. In the first example, I will focus on the Eurozone. The table illustrates futures contracts on Euribor. The 3-month Euribor interest rate is closely aligned with the ECB's deposit rate, currently set at 3.50%. Based on the 4 October data, I calculate the forecast as follows. Deposit rate equals 100 minus 96.80 equals 3.2%. This suggests that, as of 4 October 2024, the market expects a 25 basis point cut by the European Central Bank at its 17 October meeting, followed by at least another 25 basis point cut at the 12 December meeting. The second example concerns Australia. The table shows the 90-day bank bill futures contracts. The current interest rate in Australia is 4.35%, and according to forecasts, it is expected to be cut by 25 basis points by the end of the year, as indicated by the following calculation. Interest rate equals 100 minus 95.88 equals 4.12%. Before concluding, it is useful to make a couple of observations about the ECB. When the ECB decides on interest rates, it generally adjusts all 3 main rates, but in rare cases, it may intervene on only 1 or 2 of them. For example, the ECB might decide to cut only the deposit rate to encourage banks to lend more money, while leaving the main refinancing rate unchanged. The second observation is that it is essential to closely monitor the values of futures, as they can change quickly and significantly, thereby influencing expectations about central bank decisions. In summary, while futures provide valuable insights for anticipating interest rate movements, it is important to recognize the inherent uncertainties and risks involved. Flexibility and adaptability are key in navigating the ever-changing financial landscape. Although useful, futures-based forecasts are not infallible, as they reflect current market expectations, which can shift rapidly in response to new economic data, policy adjustments, or unforeseen events. Thank you for watching this video. I hope the information I have shared today has given you new insights to improve your approach to trading. Let me know your thoughts in the comments below. If you found these insights helpful, please give the video a like. And if you don't want to miss any future content, feel free to subscribe and click the notification bell. See you in the next video.